Well, hi, everybody. I'm Rick Edelman. Thanks for joining us for today's webinar. This is going to be a really timely conversation, and I'm really happy to bring on with me Andrew Nelson, CFA, Director of Product Strategy at Innovator ETFs. Andrew, great to have you with us on this webinar.
Thank you, Rick. I appreciate you having me and glad to be here.
This is, yeah, you say this now, but let's see how the conversation goes. I mean, talk about timeliness of this conversation. Officially, we're talking about managing risk and return when investing in Bitcoin. And let's emphasize those two words, managing risk. The past couple of weeks have been a reminder, in case anybody needed it, of the volatility of Bitcoin. So let's start right there. Andrew, what do you see as the landscape these days? What does the market volatility of the past few days tell us about investing in Bitcoin?
It's a great question to start off, Rick, and then just an easy softball to handle from the get-go. I say that sarcastically because I think anybody that would sit here and tell you they know where Bitcoin is going is probably lying. I think though the volatility in the marketplace does make the case inherently for what we're talking about today. There's a reason you want to have a risk managed approach to hopefully kind of trim the tails, you might say, of the worst risk possible in the portfolio and position for more of a steady outcome. I think overall, we view Bitcoin as a important part of an asset class exposure in a portfolio, and certainly a long-term discussion we can have about that later here this morning, or this afternoon, excuse me. But I do think that the volatility has certainly brought to mind the benefits of this sort of idea, having a risk managed approach, because you want to, again, avoid the deep drawdowns that you might begin to see enter the marketplace in the last few weeks.
And so let's really talk about that. And by the way, you're welcome to join the conversation as well. Many of you already have. When you registered for this event, you sent me your questions. I'll be peppering those questions to Andrew as we carry this conversation. If you have a question that arises as a result of what you're hearing, just go into your Q&A box here on Zoom. I'll be curating that as we go and fielding those questions as we can to Andrew as well. Uh, Talk about that volatility notion, Andrew. Good versus bad volatility. Such a thing?
Yeah, we think there is. And this is where, again, you could really get into the weeds with certain different financial ratios and diving into people's analysis of different products and different outcomes. But in reality, we all know that Bitcoin is a volatile asset class, much more volatile than the S&P 500. And folks might argue that the volatility has been declining slightly over the last couple of years, but it still feels pretty high to me. And so when you talk about volatility, you do want to then discuss good versus bad. And by that, I mean the upside volatility versus downside volatility. And intuitively, you want to avoid the downside volatility, meaning those sharp moves lower. And so, what we're trying to do with this discussion today is illustrate in one of our ETFs how we are trying to maximize actually the upside volatility, but still kind of cap off that downside. Because people know this intuitively again that the risk of loss is felt so much more than that pleasure of gain. On top of that, that risk of loss then buries you into a hole that you have to dig further out of. So the idea is that down versus up, you want to avoid that downside volatility and keep the good in Bitcoin.
And now you can see why I've asked Andrew to come on to this webinar for us. He's comes from the TradFi world. He comes from the ETF world, and has made the move over into ETFs that are dealing in Bitcoin right now. And your career experience is increasingly common, still not mainstream yet, but increasingly so as folks are moving from Wall Street over to the crypto side, and you've got a little bit of a healthy blend of the two because you're still dealing in the ETF world, but paying attention to crypto. What was your experience, Andrew? When did you jump down that rabbit hole into crypto and
Yeah,
Bitcoin?
it's a great question, Rick. So on a personal note, I think it was maybe 2017. So I'm certainly not an absolute first to market. I know that there's a lot of folks probably on this call that have been in it since say 2011, 2012 when it was really nascent.
Yeah, I was in
20,
2012. Yeah.
yeah, there you go. 2017, I had a conversation with some friends, just talking about the markets and talking about life and this Bitcoin idea, and still felt pretty new to me. I thought, well, how do you actually get into this? What do you actually have to do to be a part of this Bitcoin community? And so I think I downloaded the Coinbase app on my phone at that moment and bought a little bit of Bitcoin, which I still hold today. And that was my beginning. So it wasn't, I didn't jump maybe with both feet in, maybe like you did, Rick, but I began in 2017 to be curious about it. And then, as you mentioned, having a career in the ETF space, it has become much more of a merged opportunity now with the launch of crypto inside the ETF wrapper. It does a lot of good for folks, a lot of good for, again, the advisor community, and a lot of good for the investor community by democratizing access a bit more and opening doors that maybe were closed before and giving folks options as far as how to access crypto in their preferred method.
And in fact, Innovator's not one of the best known ETF providers. So tell folks who are not as familiar with the Innovator story what y'all are doing.
Yeah, we strive to become one of the best known, but Rick, your statement's accurate. We're still pretty young. We were founded in 2017. Our first ETF launched in 2018. And really what we're known for is being the creator and the pioneer of this defined outcome ETF idea. Now that's not related to Bitcoin, but think of it as being a more options-based, risk-managed portfolio. These ideas are including, again, options as implementation, and the whole point is to provide a risk-managed outcome or a shaped return profile. And so that really fits nicely into our conversation. But we were, again, founded in 2018. Right now, though, we have seen very strong growth. And so that number as of 12/31 on your screen has only increased in the first few months of this year. So we're at north of 23 billion in assets. Extremely healthy growth there, and we're excited to see it continue. But this Bitcoin ETF we'll discuss an extension of this DNA of using, again, this risk managed options based approach to provide clients different outcomes than they might normally receive.
Well, I think that's a really good place to begin because we all are familiar with Bitcoin's volatility. This is a key reason why people don't like it and are skeptical of it, afraid of it. There are those who invest in Bitcoin, I would argue, despite the volatility. They acknowledge that volatility is an inherent nature of Bitcoin, and there's more upside volatility than downside historically, and there's a high degree of confidence in the Bitcoin community that that will prove to continue to be true. And yet there are some folks who would love to have their cake and eat it too. They would love the idea of enjoying the exposure to the upside while protecting themselves against the incredible downsides we've seen. What is it, 7 times so far? We've seen 70% declines or more in the 15-year
Yeah.
history of Bitcoin, and people would love to avoid those massive drawdowns, if not for themselves, and certainly for their clients who might not be able to, tolerate that, lack of a strong stomach. So this brings us to the particular product that you guys have recently launched. The ticker is QBF. You call it the Uncapped Bitcoin 20 Floor ETF. So
Yeah,
you
it
got to
rolls right off the
explain.
tongue. Yeah.
So you got to explain. There are two key phrases there: uncapped and 20 floor. So explain all this.
Yeah.
How does it work? What's it? Why is it different? How is it different from the ordinary Bitcoin ETFs that came on the market about a year ago?
Yeah, great question. Now, Rick, if you would throw that slide up that I sent you earlier today, just to put a visual for folks out there, it does, I think, do a good job of describing what you mentioned. So the name of the product, the Innovator Uncapped Bitcoin 20 Floor ETF, it certainly is a mouthful after the joke I made, but it is intentionally named. So there's kind of three things that are important about this that come out in that name. And first and foremost, this is uncapped upside potential. Now, the reason you do this is for the conversation we've had thus far is to take advantage of that upside volatility of those sharp swings. You actually want to be in the riding it up on the good times and in the market during those times, and yet you have that concern of downside volatility. But first and foremost is the uncapped upside potential. Now, we'll get to how this works, but again, there is a cost to putting protection in place. So our ETF will have what they call a participation rate, and we'll get to you how that works. But for us right now, that's an 80% participation rate. There is no cap. There's absolutely no cap. But if Bitcoin runs up 100%, which is it could easily do, as we all know, you'll be up 80%. Bitcoin goes up 200%, you're up 160. You get the idea. But there is no hard cap. Now, again, you can read on your screen in front of you, the average quarterly gain is 60%. So this is the beauty of the joke I use is keeping the hot in the hot sauce for those that follow the industry veterans and heard that phrase before. So it's uncapped upside potential, but then you do have on that number two there, a risk managed approach. We have a 20% max loss. Now, what this is a 20% floor, which, as I'll explain a bit later, Rick, too, is different than a buffer. But the floor is that you are on the hook for the first XYZ% of losses until that floor, and you're protected beyond that. And so in our case, you actually are on the hook for the first 20% of losses, but you are protected beyond that. And Rick, you've mentioned multiple time periods of 70% plus losses. And so we are, again, capping your loss at 20% on the downside. And then the last part is quarterly. And this is also unique and differentiated because most firms have launched ETFs that are either just long only exposure or they've gone with more of an annual look at the marketplace. And we've done this quarterly. So this occurrence of your uncapped upside and your 20% floor, they reset each quarter. Every 3 months on the calendar quarter, they reset. You get a fresh 20% of protection on the downside, excuse me, fresh 20% floor on the downside, and again, an uncapped upside profile. And so it's all about giving you simple, easy to implement simplicity in the portfolio. And because Bitcoin returns tend to really flip back and forth, you don't want to have to, again, wait the entire year to experience Bitcoin's return profile. You want to each quarter have a fresh opportunity to participate in that upside and kind of step up your exposures, if you will, while instituting a new floor beneath it. So I've talked a long time, Rick. I'll pause there, but that's kind of our thought behind this uncapped 20% max loss over a calendar quarter.
Well, I appreciate that info. It's really helpful. Let me ask you some questions about the 3 points you just cited to make sure I understand and make sure everybody else does too. First, on the uncapped upside, you said that you're only going to capture 80% of the upside, and that's because you're paying for options contracts to provide the
Correct.
downside protection. And that's why you've got number two, the max of 20% loss. You're taking 20% of the capital essentially and buying the option protection. Yes?
Yeah. So the way it's instituted is that you have, again, this exposure down to kind of that 80% level of Bitcoin. Think about Bitcoin at a dollar, you're protected. You are on the hook for it to decline to 80 cents. But anything below that, you are, again, safe from. And that, again, resets each quarter. Yes, you're correct. So then you have that upside going back up, but you're, again, protected. You're on the hook for that first 20% of losses, nothing below that.
And at the end of the quarter, when it resets, that means, let's say, for example, worst case scenario, Bitcoin falls dramatically, kind of what we've experienced the last week or two, and you hit that 20% decline. Bitcoin goes down, we'll say 50, but you're protected. You only lost 20. You didn't lose 50. The quarter comes to an end. It's resetting. So does that mean you can lose another 20% in the second quarter?
Yes, and I want to be clear, we're not trying to confuse folks. You could. Now, again, the beauty of the Bitcoin return profile, and this is why we designed it as such, is that returns tend to oscillate. They're not really trending. They tend to kind of flip back and forth. You can see this in the numbers, which we could share after the fact, but it doesn't, there's never been a time when you've had 4 straight quarterly losses in Bitcoin. But the exposure does reset each quarter. Now, I'd flip that question and say it's actually to the positive because you've seen time frames, and we could show this slide later too, Rick, not right now, but you've seen time frames where Bitcoin maybe has fallen, say, 40% in a quarter, only to rocket back up 100+% the very next. And so if you are not being able to reset your exposure, you wouldn't participate in that full upswing. Whereas with our methodology, you will, because each quarter you get, again, that fresh 20% floor, and again, the ability to participate on the upside as opposed to having to wait for the full year to kind of feel those gains or feel those losses.
Makes perfect sense. And you cited the quarterly reset. There's a presumption empirically that somebody owned the shares on the first day of the quarter and still owned them on the last day of the quarter. Of course, that doesn't happen in the real world. What happens if somebody buys shares, for example, right now? I mean, Bitcoin is
Yep.
down, what, 10, 15% over just the
Yep.
past few
Yep.
days. To your point, it's recovered as we're speaking
Yep.
nicely, which shows how volatile it is day to day, even hour to hour. So, what happens to an investor, or what's the implication for an investor if they buy the shares after the decline has already occurred?
Yeah, it's a very timely question. That's why this it's a great time to host this webcast. So the beauty of the ETF wrapper is that it is able to be liquid intraday. You can buy and sell whenever you'd like. There's no lockup periods. I'm saying things that folks are most likely aware of, but that is the beauty of the ETF wrapper is flexibility. Well, with our ETF, yes, the parameters will reset on a calendar quarter, but you can buy and sell whenever you'd like. You're not required to hold it over the course of 3 months. You don't have to hold it for a calendar year. You don't have to hold it for one day. You can buy and sell whenever you'd like. But what it makes it interesting is that because you are able on our website and on publicly available sources to see the position of the ETF every single minute, every single day, you can possibly find interesting buying opportunities. So to Rick's comment, if you were to go to our website today, you'd notice that the Bitcoin ETF, QBF, is actually down about it's been about 13% down, but it has about 7% left in its floor. So you have the mindset say, well, do I think I want to be on the hook for 7% of a max loss over the next 20 odd days? You know that's your profile. You have, again, that 80% upside participation and a known 7% now max loss because we've already fallen 13% over the next, call it 20 odd days till it resets on 331. So you have these very interesting entry points where I would almost argue anytime the ETF falls below its starting value is a better entry point almost, because now you know your floor is that much closer and you still
Right.
have that participation on the upside. So again, you are able to enter and exit any point. And even right now today is a very fascinating entry point because you've already eaten into most of your floor with a few more percentage points to go, and you only have 20 odd days left in the market. You might as well, again, begin your exposure now as opposed to
Right.
wait until that 331 date. It's fascinating.
So the first day of the quarter is a 20 floor, but
Yep.
here we are in the midst of the quarter. It's only at this stage a 7 floor. Um,
Correct.
that's,
Yeah. So yeah,
so it's just a wonderful little example, a reminder to us all that the best time to buy is when prices are low, and this is an indicative of that. Uh,
absolutely. And
so pretty
you'll
cool.
see, yeah, Rick, some of our products, you'll see if you know the innovator lineup, and maybe most folks don't, there's a bit of a lag between, say, the reference asset, we call that, and the actual ETF. And that's to say, if Bitcoin falls 10%, as I mentioned with this floor, you'd be on the hook for all 10%. But the timing is important. So you'll lag a bit coming down. Well, our QBF ETF is going to track pretty darn closely. So Bitcoin as an asset class is down, call it 16%. We're down about 13, but you'd feel that fully over the course of the outcome period. It's just a matter of the timing. And so that makes it all the more interesting also for entry and exit points, because you have the ability to, again, realize that floor faster, if you will.
You've got a couple of other slides. You want to show them now?
Yeah, let's go to the next one if you wouldn't mind. This view here is what we're calling a kind of a case study, and I think it really obviously makes the point that I'm trying to make verbally here, to say, let's look at two recent. We're not even going back to say that 2014 timeframe, but two recent sell-offs to illustrate the value of combining these three benefits. It's kind of the synergistic benefits is a mouthful also, but you'll see here 2018 into 2020, you had a multi-quarter sell-off that you see there. First quarter 2018, you're down 51%. I'll just call out that you're also down 44% shortly thereafter. But within that kind of sell-off time frame, which was a 75%, 74% max drawdown, you lost 74% of your assets if you were being at the first quarter 2018 until that trough. You had periods where it rallied 170, 170%. Now, there's a lot going on this slide, but just so we're clear, when these orange bars are combined, it only brings you back to zero. Does that make sense for us to say, like, we started at a point, you fell 50%, you fell another 14, you fell some more, you came back, and we're kind of back at zero. But if you have a quarterly reset in place, you both have capped your losses and you're able to participate in that 178% upside quarter as well as 170% upside quarter. And so when you have this idea of losing less and digging out of a smaller hole, you end up with an actually outperformance over these downturns. Now, we're not calling for a long-term. I'm not trying to say this is better than Bitcoin and the rest. We're not making portfolio statements, but I'm saying over these drawdown periods, you'll see the benefit emerge where you can say cap your downside and experience quickly that volatility to the upside in a positive manner. And even in 21, 22, similar fashion, don't need to rehash all the figures, but you see a lot of deep orange bars and a lot of tall orange bars. And that's showing again that in that time frame between mid 21 till even late 23, over that course, you had again a 70% drawdown over that life cycle of this peak to trough event. And you now are able to avoid that with a 20 floor in place and really lock in the gains that you see stepping up each quarter. So these are just two examples that are real life examples of Bitcoin's really manic swings, if you will, in the portfolio, and how you really, it's a difficult time to predict returns. And yet the way to do it with a quarterly approach is to allow your exposure to reset each quarter.
To me, this product is as much about behavioral finance as it is about market performance. It's we know that so many investors refuse to do what they should be doing at the time they should be doing it. We all love to buy high, sell low, for example. And when we see the volatility like we have in this past week, in not just Bitcoin, but the financial markets overall, for all the reasons we all know what's happening politically and policy making, US and foreign, that this is kind of an environment that scares people out of the markets entirely. The run to cash. And of course, they're running to cash after the prices are down. They didn't run in anticipation of it. And this kind of a product, because you're preventing massive downside, uh, could help people develop the confidence of hanging in there. And that, to me, is priceless.
We agree, Rick. I think I will push back slightly and say I think it's a combination of the behavioral finance aspect with also still maintaining that uncapped upside, right? The goal here is that actually over certain life cycles, again, I'm not promising outperformance, but you end up with a very attractive risk return profile, not just avoiding folks to kind of avoiding their selling at the wrong time, but you actually come with that with with a actually healthy cumulative return figure versus broad Bitcoin when you can avoid these deep drawdowns in a portfolio. And so we view it, again, to your comment, as a way to, if you have Bitcoin in the portfolio, this is a great way to add, right? This is adding new. If you have never been into Bitcoin because you have that fear that it's going to say go to zero, or that fear of the massive drawdown, this is a way to enter that portfolio and enter that space also with your portfolio. So you're right. It absolutely is a way to, again, get clients comfortable, but it's not just that. It also actually is a very, we think, positive potential outcome for clients, regardless of their behavioral finance skills, because of that risk return profile that you are able to adopt by taking, again, the left tail off, if you will, and keeping that right tail uncapped.
So you think that theoretically now, we're not making any predictions or promises or anything like that, but theoretically, are you saying that it's possible, due to the floor, the combination of uncapped upside with the floor downside, with the quarterly reset, that this ETF could outperform Bitcoin itself? It's the total,
Yeah,
the
I,
net gain at the end of the year could be higher here, even
yeah.
though you're only getting 80% of the upside, you could still end up earning more than in a pure Bitcoin play.
Yeah, I'm comfortable saying that. And that's just empirically the case of the math behind it. And so again, we're not making any promises. This full disclaimers here, but when you have life cycle, say even over the last 3 years, encompassing that 2022 sell-off, you see the benefit of this strategy in place because you are able to actually outperform Bitcoin over that time frame because you've avoided that deep trough. And so yes, that's absolutely the case, that you will have pockets of time when this, again, on a risk adjusted basis and a total return basis, has actually outperformed stock or broad Bitcoin unhedged because of that ability to avoid those deep drawdowns.
You had mentioned earlier, before I get to that question, that somebody has just asked, you've got a third and final slide here. Why don't we take a look at that
Yep.
and describe for us what we're looking at here?
Yes, this is just to counter your returns. And I keep this slide in these sort of conversations to illustrate that volatility, which I probably emphasized plenty already. But this is that idea of just looking at the drawdowns in Bitcoin. And Rick, it's actually exactly what you mentioned before. The top half of this chart is showing the myriad amount of max drawdowns between these peaks and these troughs in this chart. And you'll see in the early 2010s, you have a drawdown of 93%, a 2018, 83%. I don't need to read it off to you all, but you see it there in front of you. And this 20% max loss is designed, as we talked about, to assist investors to stay the course. And so you'll see there, even back in 2011, 2012, 2013, even 2014, you have pretty strong performance. And folks have been implying that, hey, that Bitcoin volatility is going away. Well, look at 2021 and 2022. You have two of the worst quarters in the entirety of of Bitcoin's life cycle, where you're down 40+% and down 60% or 59% in just one quarter. And so this quilt chart here is to show you that you are usually either, in a sense, going to the moon or crash landing on a quarterly basis. And again, we think our combination is a good balance to take advantage of that in a portfolio.
Got it. We're getting a lot of questions from folks, as you can imagine. One question pertains to a comment you made earlier today, that you just made the observation when you created a floor in this ETF, a max of 20% downside, as opposed to a buffer. So explain to folks the difference between floors and buffers and why you chose one over the
Yeah.
other.
It's a fantastic question, a good clarifying point. So in a buffer scenario, which we have a number of these products as well, as Rick knows, a buffer protects against initial losses. So say you have a 10% buffer in any sort of portfolio. If you have a 10% buffer and the market's down 5, you're down 0. You're protected against the first 10% of losses. If the market's down the full 10 and you have a 10% buffer, you're down 0. But that also is the maximum protection you achieve. So in that case, if you have a buffer of 10% and the market's down 25, you are now down 15. So you again achieve kind of that net difference. Whereas a floor flips that on its head. You are on the hook. You are responsible for that first percentage of losses till that floor. Then, as the name suggests, you're protected below that forevermore. And so you have, in this case, the 20% floor we've talked about, where you are on the hook. You are responsible for the first 20% of losses. But if you hit that level and the market's down 25, down 30, down 40, you are only going to be down 20%. That's your hard floor. And so that's the difference. The buffer and a floor are very complementary in how they operate. And for very volatile asset classes, the floor makes a lot of sense. Now, to follow on your question, why a floor in this case? We felt it was a nice Goldilocks scenario. So a floor deeper out of the money is a little less expensive to operate and provides you more upside going forward. And on top of that, you had these really strong drawdowns in Bitcoin. So that 20% level felt like a nice range to capture to avoid most of those deep drawdowns and still can allow you heavy participation. If you were to set that floor higher, so to speak, at a 10% floor, even just a 5% floor, it sounds great on paper, but your participation rate that we talked about being 80% would fall. It would cost you more in a sense to be a part of that. And so we really wanted to emphasize risk manage and yet uncapped with a healthy participation rate. So that's the kind of that Goldilocks we looked at. You could construct it however you'd like. There's no exact reason you have to do it this way, but it was kind of our analysis showing that a great middle zone of saying, hey, you got a lot of quarters that fall more than 20%, and you got a lot of quarters that could maybe be up even 1,000%, maybe not a lot of quarters, but it's happened before. You want to be a part of that upside, but mitigate that downside. This is a nice balance in doing so.
Robert is asking, related to this, worst case scenario, and this would really have to be about as bad as I think it could get. If
Yeah.
you lost 20% in each quarter, you'd be down 80% for the year.
And actually, the kind of fun trivia for me going back to almost my math class, I said the same thing internally, Rick, and we actually ran the numbers. It's not the case. So 20% each quarter, you're down a combined 59%, and that's because your basis has been changing each quarter. So yes, you're down 20%. So you started at $100, you're down to 80, but 20% of 80 is not down to 60. You follow my math. And so
Yes.
actually, if you were to have the absolute worst case scenario of 20% every quarter, if you went back to the start of the year, you're actually down 59%, not 80%. Now we're splitting hairs. It would not be a fun feeling to be down 59%. We acknowledge that, but it is not quite the same as saying you're down 80% over the course of a year.
And just, mathematically, it would be pretty, I think, inconceivable, pretty far-fetched to have the market decline 20% per quarter exactly on the quarter for 4 quarters in a row. That would be.
And as I mentioned, like the other stat we throw out there to folks with that question, because it's a fair question, is to say, I've already mentioned it, there's never been a period of time when the Bitcoin has had 4 negative quarters in a row anyhow. So there's a lot of thought that goes into our product design.
Right. Theoretically, you could do this with a different reset rather than quarterly. You could do it monthly, semi-annually. Why'd you choose quarterly?
This is kind of the behavioral finance aspect. It goes back to what folks have appreciated between both cost to implement and folks' mindset towards, say, calendar quarters or annual outcomes. So the monthly you could do, it would be pretty costly and a lot of market movement and kind of embedded in that. The quarterly feels like, again, to use that phrase, kind of a nice middle ground between a 3-month period that allows kind of the market to develop a bit, but then you can quickly reset if needed. A lot of folks are looking at the quarterly returns. And so it really comes down to, again, investor preference. It's not so much a right or wrong, but again, to kind of match that trading cost versus implementation versus investor outcomes quarterly. Now, again, the outcome versus annual, we felt more strongly about. Annual is not necessarily a bad thing, but you really have a lot of movement intra-year. And so we're going to try and take advantage of that full upside potential. You want to be able to ratchet that floor up and move with the market. Now, we might come out with a different product that's annual at some point related to Bitcoin, but it'll have different characteristics on the risk side. So for this being the balancing act of, let's look at that floor, but let's give you that quarterly reset to help you move up with it. It really provides a lot higher upside potential than, say, an annual outcome ETF would, as we looked at the numbers internally.
Steve's asking the question on everybody's mind. What are the fees?
QBF is 79 basis points. And there's, as again, the ETF wrapper is transparent, clean, and easy. That's all the cost there is. There's no lockup fees, no surrender charges, nothing special, no hidden costs here. It's 79 basis points over the course of a year.
And talk about how this, there's a lot of interest these days in the ETF world. As you know, being in the ETF space for so many years, ETF providers are really good at creating product. And the launch of the Bitcoin ETFs 13 months ago has launched this whole new subset of crypto ETFs. And so along comes yours, which is, an options-driven strategy to, make a bigger, better mousetrap here. But there are some other competitors doing something similarly. So what sets the strategy you're using to hedge the risk return ratio compared to what is available elsewhere in the marketplace?
Yeah, and it's another good question, a fair question. So comparing us to, say, just the broad-based Bitcoin ETFs, everybody probably knows the IBIT ticker, of course, and the success it's seen. Great opportunity to invest there. Nothing wrong with IBIT. Our goal again was to provide a risk managed approach, and to Rick's comment, that didn't even exist. You couldn't even have done that until the IBIT ETF came out, because the options market had to develop around the ETF, and then the exchanges had to be comfortable with the options market to utilize these and create contracts, et cetera. So that evolution is almost happening at breakneck speed, even though it feels a bit slower because the ETFs itself launched now a couple of years back, or a year and a half back. But on the front about, say, competitor spaces, there are a number of firms seeking to do similar things to our risk managed approach to Bitcoin. The difference here is that so far, uh, these other competitors have taken the capped approach. And again, it's dependent upon what the investor wants. But our thought process around this is that, there are some mistakes you make in life, but capping your Bitcoin should not be one of them. Because the idea is that Bitcoin is either the absolute top performing asset class or the absolute bottom, but there's not a whole lot in between. And so you want to give that uncapped exposure. So the other risk managed options in the marketplace today are seeking to give you exposure to Bitcoin in a risk managed fashion, but they are capping your upside. And here we're trying to on an uncapped nature. That's the primary difference. And on top of that, other firms looking at more of, say, an annual outcome period, where we like to think about ourselves as this quarterly being a nice Goldilocks approach to getting you the most bang for your buck as you consider implementation.
Grover's got some questions about taxes. Does the reset that you do quarterly create a tax implication for the investor?
It does not. It's a good question. So we will, we never give tax advice, and you would have, again, an annual distribution frequency if you had any sort of income in the portfolio. We don't anticipate that happening, of course, but the actual quarterly reset is not a taxable event. And that comes back to using options contracts and be able to create in kind and redeem. So there's an element where, and that's getting into the weeds pretty deeply, but for the ETF, we do not anticipate, we hope to avoid distributions. And of course, the actual quarterly changes do not require any sort of taxable event for the end client. It is as simple as, say, buying and holding, or selling whatever you like, but there is no action need on your part and no impact felt to the portfolio from a tax perspective on a quarterly basis.
And you just said something that is prompted a question from Pete regarding the two things. One is using options contracts as opposed to futures contracts. Can you talk about that distinction?
Yeah, part of it is market availability. So the futures market is not developed here in the ETF landscape the same way. So the options market is more mature in that sense, and more known. And then on top of that, we'll use customized options contracts with our counterparties. And so there's an element there where it's a known quantity of folks, and exactly, again, the exposures you're achieving at that point in time, as opposed to, again, being based upon some of the unknown. So it's you can construct things different ways, but for us, using options is probably the easiest and most straightforward as far as the actual portfolio construction side.
And I'm assuming you're buying puts.
We actually are not in this portfolio, Rick. So I don't know how deep you want to go here. We are actually we are long calls at the 80% level.
Got it.
And then that's our kind of exposure to Bitcoin, and then we are selling some exposure as well to pay for that, and then having that participation rate.
And Pete's got a related question to this, and along with Nate's earlier one on options versus futures. Pete's wanting to know the impact or implication for your buying options contracts through the quarter. In other words, today we're in the middle of a quarter. You have net inflows of assets. You need to buy more options contracts, right? For every dollar you get in a net inflow, you need to buy an options contract for that dollar of added asset. Yes. And so talk about the pricing implications on buying those options contracts during the quarter.
Yeah. Great, very insightful question. So our ETF is constructed on top of an options contract that references 10 to 13 different Bitcoin ETFs. It's not just buying, say, IBIT options. We're buying a SIBO index option, and that has pretty deep liquidity across its book. So if intra-period, if a money flow comes in, we're able to go to the market and very easily trade this option contract on the terms of that date without having any massive market implications. Now, again, if you look at, say, volume stats across those Bitcoin ETFs themselves, it's really grown, really grown exponentially. I think we looked at this through January, say, through January, it's something like 122 million shares traded with the volume for the top 12 ETFs. On top of that, you now had notional volume reaching $4 billion. And so my point in saying these numbers quickly is to say that there's a deep and developing liquidity ecosystem around the Bitcoin ETF landscape, and our options contract references those. And so then to transact intra-period is not a problem for us, because the market makers are able to apply the liquidity needed. It's a good
One of the
question to ask.
benefits of being small, quite frankly, you're a little more nimble.
Yeah, a little more nimble and still plenty of room to grow. I think we lost Rick, and I think you're on mute.
How's that?
Can hear you loud and clear.
All right. Well, I'll take over while he's getting situated. So, in theory, then, can you actually, if the thing hits the bottom, hits the floor, could you effectively, whatever price that's at, could you buy at that price, and then
Yeah,
you're
absolutely.
basically your exposure is zero?
Yeah, Don, you're hitting the nail on the head, and that's why I was secretly hoping for a continued Bitcoin slide today. I jokingly say that, of course, we want to see the Bitcoin market rally long term, but if there's a Bitcoin slide today and you're able to say approach that floor, it really provides a very advantageous buying opportunity because you cannot lose any beyond that. Now, to your point, Don, to get a bit in the weeds, you will then have a slight lag in the recovery because you're always kind of lagging the price a bit. So you might see Bitcoin turn quickly and the ETF takes maybe a couple minutes, days to catch up, but you will actually, as you know, have that floor beneath you. So yeah, it's a great chance to look at that and think, well, my max loss is zero. Let's go ahead and buy some Bitcoin and see where it goes and have the exposure on that point.
All right, Rick's back.
So Don is my options contract. He provides me on the floor. So if my tech fails, the show will go on. So you'll have Don and I tag teaming for the rest of today. One of the we're getting a series of questions, all kind of thematic. So I'm going to ask here and there, but they're all in the theme, Andrew, and that pertains to how advisors are using this ETF. What kind of a client is this really designed for? How does an advisor succinctly explain this to a client? What percentage of a portfolio allocation are you generally seeing being used for this in the overall portfolio? So, all of that and more as you can envision, all practice management related issues.
Yeah. So let me take a few of those, and then I'm sure I'll forget part of that question, Rick, and please ask it again because it's spot on to what we've seen a lot. It's a very practical nature of how does this actually apply in a practice, and why should I care? And it comes down, I think, to two areas. One is going to be, as you mentioned, the client who is asking for it, the client profile, and two is about more the practice management element, making the life easier on the advisor and on those that are actually introducing this in their portfolios. And so here's what I mean by that. From a practice management standpoint, if you're an advisor, and even if you're an individual investor buying this for your own portfolio, it really simplifies implementation. Now, that's versus other risk managed options. I understand that you can buy Bitcoin directly or buy IBIT directly. That's not what I'm referencing. What I'm saying, though, is if you're trying to get a risk managed approach, it simplifies implementation. It's one ticker. It's not, it resets for you. It's not, say, a long dated. It's one ticker dynamically adjusting. It's fewer emotional phone calls from clients. You have less of the downside to worry about, gives that sleep at night quality, less check-ins. And we view it actually almost as a competitive edge for client acquisition. Again, if you're an advisor listening today and you have clients coming in the door, this is your unique value add to say, I can get you Bitcoin exposure in a risk managed fashion. And then it's also then for those that are clients that are pushing for more Bitcoin, but even the advisor saying, listen, we know that small allocations can add value. We agree with that, but too much can maybe skew the portfolio in the wrong direction with increased volatility. Let's get that, you get a more Bitcoin exposure that you're asking for, but do it in a risk managed fashion and help kind of add value in the portfolio without disrupting those kind of long-term financial plans you put in place. So it's those that have that desire for more. And then it's also on the exact flip of that. You have the opposite, say the client that comes in and says, I hear a lot about Bitcoin, but I'm still really, even today, I'm really nervous it's going to go to zero. I'm really nervous it's not going to work out. I'm really nervous that the US government won't have a stockpile or whatever it is, which still, that's a valid concern in some sense. Well, then this is the way I say, listen, you want to be in that marketplace. There's the thesis for long-term upside, but we can put some guardrails in place and have you, again, more of a sleep at night quality. We did a study looking at unhedged Bitcoin, just buying Bitcoin as your community knows well, Rick. And you guys know this, but even just a 1% allocation, as you know, can increase risk-adjusted returns. Even up to almost that 8% allocation over certain timeframes can increase risk-adjusted returns in a positive fashion. Well, with a QBF idea, you don't need to go, say, to that 8% allocation to increase risk-adjusted returns because that downside risk is mitigated so much. And so you're able to, again, add into the portfolio a positive outcome with less capital at work and still maintain balance in the portfolio that way. So I don't know if I call all of that question, Rick, but a lot of practice management side is it makes your life easier from a client base. It's extremely simplistic to implement. There's also just the benefit. We saw the buy bet hack a little while back. I'm not saying that any ETFs are perfect, but this is again, giving you options-based exposure to the ETF, to the Bitcoin landscape. You don't need to worry about managing keys or passwords or different client accounts and different platforms. This is just going to integrate into your existing portfolio quite simply.
The one, all great info. Thank you, Andrew. The one question you didn't address, you kind of mentioned, no need to do an 8% allocation, but what are you actually seeing advisors doing? Are they generally doing low single digits?
Yeah. So I wish it would be 10, 15, 20%, right, Rick? But it's not. And maybe it shouldn't be. But we are seeing low single digits. They're not actually changing so much of their Bitcoin allocation as they are changing the vehicle into it. So it's clients I've talked about. You could increase allocations. We could coach that direction and say, hey, because of that risk profile, the fact that your standard deviation is so much lower using a risk managed approach, you could probably up it a little bit. But most clients aren't going into that trying to say ramp up their exposure. They're trying to get their clients comfortable with the existing and provide a risk adjusted returns to the upside. So it's not been more than, say, that single digit exposure we've talked about, but it is a way to get folks into the door. And again, even that tool about client acquisition has been fascinating to see clients say, well, or financial advisors say, I could use this as a way to interest clients and show my value to them and not have to then have a deep conversation about Bitcoin as an overall asset class.
I think there's an additional benefit. You kind of touched on it lightly, but I want to really highlight this for everybody. One of the reasons that I have been enthusiastic about the crypto asset class for so long is not only because I think it checks the boxes on a modern portfolio theory perspective on risk return matrix, et cetera. I don't merely think that it's a great opportunity for investors. That is certainly the case, but there's an additional reason I have often cited, and that is the practice management element, meaning that this is a way to differentiate yourself in your practice because most advisors still are not yet fluent in crypto. They are not yet actively engaging with clients in this conversation, and fewer are serving clients by giving them a recommendation for how to allocate and bring the assets in house. So now that the Bitcoin ETFs have been around for 13 months with an incredibly successful track record, the best performing ETF debut in history, as we all know, they are ubiquitous. All of them are pretty much the same thing. They buy Bitcoin and they do it very inexpensively. There's not a lot of distinction between one to another because they're single asset ETFs. So I put them in the category of an S&P 500 stock index fund. Anybody can go buy one. It doesn't take a lot of expertise, time, or money to do that. What value add is the advisor really providing to recommend a S&P 500 index fund to a client when that's readily available anywhere incredibly cheap? In a similar way, you can make the same statement about the Bitcoin ETFs. I'm willing to bet that even if your clients have heard of the Bitcoin ETFs, and that's an increasing likelihood that they have, I'm willing to bet they've never heard of the Innovator ETFs, and certainly not the QBF, the Uncapped Bitcoin 20 Floor ETF. It's a way for you to say to the client, essentially, I know more than you do. And there's an opportunity for you to allocate to this space in a manner you didn't even know existed, didn't even understand was available. And it's because I'm better at this than you do that I'm showing my value to you. And that, I think, has a tremendous value for both you and the client. You're showing the client something that they, I think, would really enjoy, a floor against potential losses, and showing them that you are deeper in the space than they are. We're reinforcing the message of why they need to rely on you, not just on this low single-digit asset class, but every asset in their broad portfolio. So I think that's a huge benefit, Andrew, that Innovator is bringing to the table. It's a way to help advisors build their businesses while serving the client's best interests.
Yeah, we would absolutely agree wholeheartedly, Rick. I think it's well said. I think also there's an element too where people have kind of that recency bias where they remember what's most recently happened. And up until, say, maybe a month ago, post 22 had been a really strong bull market again for things like crypto. But people forget that Bitcoin has almost experienced losses twice as often as the S&P, right? Like the losses happen frequently. And when they happen, the magnitude is nearly as the large losses are nearly as often as the small. So there's this element where you can talk to your clients about, yes, you can add value in the portfolio, but you know that these stats exist that they don't because they just see the news cycles, they just see the headlines, and you're more deeply into it thinking, well, hey, over the long term, you do need to be aware that the drawdowns happen twice as often. And when they happen pretty steeply. How can we mitigate that? And the way to do that is with QBF. But I think you're absolutely right, Rick. There is an absolute practice management element we've seen come to the fore. And also, again, that simplification side of it too. We had a client talk about they're managing multiple different platforms and accounts and keys, and the client had okayed that, but it was a lot of work to keep track of crypto in different places and to monitor that and to manage that from a risk standpoint where they're trying to sell at certain market levels, et cetera. And this takes all that out of the equation and says, hey, on a quarterly basis, your max loss is 20%, you get 80% of the upside, you're off to the races.
A few other practice management questions in detail on the portfolio side. Number one, again, a tax issue. This is okay for use in an IRA?
Correct. Yep. No issues there.
Philip wants to know about counterparty risk as a result of using options.
Yeah, it's a great question, and one that we get for all of our portfolios. Since Innovator primarily deals in options-based ETFs, our options are OCC cleared, so that's the counterparty in our sense, meaning that there really is, I say, no counterparty risk. The OCC, the Options Clearing Corp, is a SIFMU, is a SIFMU, a systematically important financial management utility, and so there's a financial market utility, and so there's an element where it's essentially government guaranteed, whether you agree with the politics of that or not. It's too big to fail. And so the OCC is a counterparty to our options contracts, not say an individual bank. There's no credit risk. There's not, I'm not relying upon JP Morgan or Wells Fargo or Citigroup to execute these contracts. It's, again, exchange traded, market based, using the OCC as the counterparty in that sense. So a great question, a very intelligent question, but one that hopefully is mitigated by the fact that you are, again, using regulated contracts in the marketplace backed by the OCC.
You did not launch this ETF on January 1, so Kevin wants to confirm that the quarter end is March 31.
Yes, that is correct. We have a bit of what we call a stub period. So the listing date is only February 6th. So it's only been about a month and change here. And the reason is just that, Rick, you know this, how launches occur and funds come to market. It's a matter of all the operations teams lining up and all the actual systems becoming online and ready to go. And so we chose to launch it at just a stub period, interim period. Let's get it out the door February 6th. It'll reset March 31st, then have a calendar quarter cadence going forward. So you've got a reduced outcome period, if you will, this first time, which makes it all the more attractive, frankly. But again, you have that calendar quarter beginning March 31st and on. It's a good question.
I launched the second most successful ETF in history with BlackRock back in 2017 until the Bitcoin ETFs came about. Now it's the 11th most successful. So,
hey, nothing to be ashamed about. That's still a great launch.
Reginald wants to know what your plans are for the future. Are you going to be doing this for other digital assets? Is an Ethereum version next?
We'll never say no to anything. I think I've learned enough in my 15 years in the industry to know you never say no to anything. But I think right now our primary focus is on Bitcoin. I think you've seen, again, most of the market cap is based upon Bitcoin still. Most of the investor interest has been in Bitcoin, and most of the market maturation has been in Bitcoin. You'd have to, of course, to that question, have Ethereum ETFs really gain traction and become a viable option, and then also have, again, the options market develop off those. So never say never. Right now, our focus is most likely on the Bitcoin space in the near future. It's a good question.
I want to remind everybody, I should have said this earlier, the 3 slides, because I had a couple of folks ask if you can access those 3 slides, and the answer is yes. Those 3 slides are actually part of a bigger deck of great content and information, and we're going to push that out to you right now. Michelle just did it. It's in the chat box here on Zoom. You can just click that link and you'll get access to the full deck from Innovator, which includes those 3 slides that you saw earlier. So thank you, Michelle, and be sure to download that because it's really great info. We're also getting a bunch of questions here, Andrew, about just big picture. They're kind of related. The questions are on both sides. On the one hand, a bunch of questions about Donald Trump and his policies on the economy, the stock market, the tariffs, the taxes, all the stuff that's been creating the market volatility of the past week. And related to that is the strategic Bitcoin reserve that the president announced last week. So the 2 questions which are kind of colliding together are, what do you see as the impact on the markets, particularly Bitcoin as a result of everything going on, and related to that, your long-term view. And if you have a bullish long-term view, to what degree do you need to use an ETF that has this kind of downside risk protection?
Well, I think it's a fair question. I'll take it twofold. First, the Donald Trump side, I think just the creation of a executive order, I think that's official term, or for a crypto reserve fund, is a net positive long term, illustrating the fact that he believes in Bitcoin and the U.S. He wants to become, I think, the crypto capital of the world. He called it earlier. So whether politics aside, it sounds more bullish in the long term to have the U.S. involved in Bitcoin as a reserve asset. In the near term, I think there was some initial disappointment around the view that he could have gone even further, talked about even purchases that were going to be adding to that, and they didn't go quite that far. But as far as the overall tenor of the administration, it seems to be very crypto positive. That's good for the long term view. To your point, though, around if it's going to be bullish long term, why do I need a hedge? I think that's the crystal ball of, if I know the S&P goes up over the course of 50 years, why do I need a hedge? And it's about timing risk and about the unknown. So even if you are bullish, as you've seen from the slides I've illustrated, I hopefully sufficiently, there are still going to be wild swings along the way. And so if you have client accounts that want to be invested in, say, Bitcoin, but might be nearing retirement, or invested in Bitcoin, but not, you have a decumulation event coming up, it is very hard to look at them and say, well, we're sure that Bitcoin will go up in 10 years time. And they might say, well, I need it in a year. And so there's an element of, again, that financial planning aspect where even though you might have a long-term bullish view, it still pays to have, say, a risk managed approach in place to avoid that drawdown aspect of the portfolio. So that's where I'd probably go with that question, because again, the same thing applies to the S&P. Everybody knows or assumes the S&P will go up for the next 50 years, but you just don't know when and exactly how. And so to put it in a portfolio context of actual kind of CFP mindset, you need to be able to talk about risk management along the way for the sake of the client's portfolio. And I think that's what we're doing here at Bitcoin.
Yeah, it is one of the concerns I've had of late. Ever since the election, frankly, there was such enthusiasm over the president's election in the crypto marketplace because of his bullishness on crypto compared to Kamala Harris's viewpoint on the topic. And so for those who are lamenting that Donald Trump's remarks over the last few days have been very bad for the market and have caused Bitcoin to drop dramatically, if it wasn't for Trump's election, Bitcoin would not have doubled in value since November. Let's not forget that. So on the one hand, we have a bullishness about Bitcoin. On the other, what it's causing people to do, when we went from 40,000 to 108, an incredible straight line up and to the right. And the predictions of so many saying 500,000, a million, 5 million of Bitcoin value in the next 5 or 10 years. You see these predictions everywhere. I've made one of them. There's an assumption or a casualness where people are assuming it's up and to the right like a straight line on a string. That's not how it works, folks. We have to remember that this is a incredibly volatile asset, as the last couple of days have reminded us. Dealing with the realities of market performance reinforces the reason for strategic execution of sophisticated portfolio management, which is why we rebalance and dollar cost average and tax loss harvest. And now the existence of options trading that can help mitigate downside risk without significant sacrifice of upside return. The notion of just what I would call a naked long position may be so 1980s.
Yeah, we don't disagree. I think it's like, again, we talked about it a lot, but it's putting that seatbelt on with that 20% floor. It's keeping the uncapped nature. Again, to get that upside potential, you need to have some downside risk associated with that, but it's not always straight to the right. So it's a way to, again, allow you to be a part of that movement, but not have to, again, apologize to your clients that you've lost, say, 70% in a drawdown.
Well, this has been fascinating conversation, and I think, Andrew, you're going to be getting a lot of inquiries from folks seeking to learn more and to understand better and to get your advice and counsel on execution and using this in practice management. I think this is something that people are going to be paying a lot of attention to. That's Andrew Nelson with Innovator ETFs, and we've been talking about the QBF ticker, the Uncapped Bitcoin 20 Floor ETF. So this has been really terrific content. I want to let you know that we have a couple of more a couple of more webinars coming up on March 25th, how you can use Bitcoin in your income generating strategies. And then on April 8th, getting Bitcoin exposure again beyond the spot ETFs, demonstrating the incredible amount of interest that everybody has on these conversations. We're going to continue to deliver them for you here at DAC-FP. And if you do want to learn the fundamentals, we've got two toolkits for you, the Spot Bitcoin ETF toolkit and the Spot Ethereum ETF toolkit, that give you a lot of articles, white papers, infographics, and best of all, a comparative chart, one simple sheet that allows you to easily compare all of these so you can see the differences between them. And my new white paper, if you haven't read this yet or shared it with clients, you really ought to. The 6 mistaken beliefs that are keeping you from buying and recommending Bitcoin, particularly important today, given the performance of Bitcoin over the past few months since the election, and most importantly, the last couple of weeks. You can click that QR code and get it for free, and I encourage you to do so. You'll really find this of tremendous help when you're talking with clients about Bitcoin. And we have a complete crypto catalog, everything in the world of crypto, the comprehensive directory at DACFP.com that is a one-click resource giving you everything you want to know. The companies in crypto that are providing research and news, all the different custodians, all the banking and tax and legal services available, you name it, it's all right there in the crypto catalog. And if you really want the deepest dive available, you want to come to Vision. This is our annual crypto-only conference. It's the longest-running digital assets conference exclusively for financial advisors and accredited investors. We've already lined up Michael Greenwald, the head of financial innovation and digital for Amazon, Catherine Molinar, who is the chief investment officer of one of the largest pension funds in America, allocating to Bitcoin, and U.S. Senator Bernie Moreno. You may have heard him on my podcast last year, newly elected senator from Ohio. All of them featured speakers at Vision, June 9 to 11 in Dallas. You can register right now for that event. And we encourage you to get your CBDA, become certified in blockchain and digital assets. The CBDA is listed in the FINRA database of professional designations. This is an online self-study program with a world-class faculty. You'll get 2 parts of the course. The first is all about the tech. What is it? How does it work? And the second part is all about practice management. Investment thesis, portfolio construction, crypto taxation, how to talk about this with clients, how to add crypto to your practice seamlessly and easily. I encourage you to get your CBDA and differentiate yourself among other advisors. And if you haven't read my #1 Amazon bestseller, my most recent book, The Truth About Crypto, named won the award for Best in Business when the book was published. Andrew, I want to say thank you again for joining us on today's program. This was terrific information, and I know the